Hey guys, today I'll walk you through my top 5 picks for Canadian growth ETFs, with the last one being my favorite. Later, also a bonus tip on how to save hundreds, even thousands of dollars on taxes just by investing in the right place, something many beginners don't know. The top 5 ETFs I'll talk about today are all listed on the Toronto Stock Exchange, priced in Canadian dollars, so you don't need to worry about foreign exchange fees. These are also ETFs that invest in equities or stocks. Side note, there are many kinds of ETFs depending on what kind of assets they hold, including bond ETFs, commodity ETFs, real estate ETFs, also known as REITs, and crypto ETFs. But disclaimer, this is not investment advice, so make sure to do your own research. So let's start the countdown. At number 5, we have the VCN. The VCN, issued by Vanguard, tracks the performance of the FTSE Canada All-Cap Domestic Index. All-Cap simply means that it contains a mix of large, mid, and small Canadian companies. The VCN is 100% Canadian stocks and has 164 companies in its holdings. On Vanguard's side, you can scroll down to top 10 holdings to see the weightings of the different companies. The VCN holds, for example, RBC stock with a weighting of 7% and Shopify at 5.78% and so on. The beauty of investing in an ETF is that you don't need to agonize about which particular stock to invest in and risk going wrong with the stock falling towards zero, especially if you don't have the time to do the research. Instead, by buying VCN, for example, you get exposure to 164 Canadian companies all at once. So even though one stock goes down by a lot, there's still a chance of other companies performing well, so you still get that growth. Unless, of course, the Canadian economy as a whole is down. One important criteria is also historical performance. Sure, the past does not dictate the future, but it can be an indicator. And combine that with your personal take, of course, on how certain markets will perform in the future. When looking at performance, I like to look at 5-year averages and growth since inception of the fund. In the last 5 years, the VCN grew on average by 11.71% per year and 9.46% since inception in 2013. Now, this doesn't mean that it will grow by 11.71% each year in the future. One year, the price could go up by 30%, then down 20%, then up 12% again, and so on. But over 5 years, it averaged out to be 11.71%, which is not bad. Next, let's look at the MER, or the management expense ratio. You'll never see it as a separate fee billed to you, but it's a fee that reduces your investment return. So you want it to be as low as possible. And good thing, VCN's MER is only 0.05%. Last item and criteria you could look at is yield. This number here, 2.61%, is the yield or the dividend relative to the price. It happens to be on the higher side considering this is a growth stock, which is a bonus. Next, at number 4, we have the XEQT. The XEQT, issued by BlackRock, is a great international ETF that holds investments mainly in the US and Canada, but also in Japan, a few European countries, Australia, and China. The XEQT is quite unique as it's an ETF that consists of other ETFs. Under number of holdings here, you can see 5, meaning that the XEQT is invested in 5 other ETFs. By investing in the XEQT, you are indirectly investing in 8,646 companies. If you scroll down to top holdings, you can see which these are exactly. Let's take, for example, the top holding ITOT, funny name, which top holdings are some of the biggest companies in the US, including Apple, Nvidia, and so on. XEF, another holding of the XEQT, has companies like SAP, Nestle, Novartis, HSBC, and Shell. It also has shares in emerging markets via the XEC, which has Chinese, Taiwanese, and South Korean companies like Alibaba and Samsung. So if you want to have exposure to international companies and also US and Canada, but don't know which to pick, you can pick the XEQT instead. It's also done very well in the past, with a 5-year average performance of 12.38% and 13.1% since inception of the fund in 2019. As these are very uncertain times, consider if it's a good idea to be exposed to high-performing companies around the globe. The fee is also very low at just 0.2% MER, or management expense ratio. The trailing yield, meaning the historical yield of the past 12 months, was decent at 1.96%. The yield is the dividend relative to the price, whereas the dividend is the amount of money paid out. If you look at the distribution yield, which is the estimated future yield based on the most recent payments, it's even higher at 3.16%. Next, at number 3, we have the XUU, which is a total US market index. The XUU is issued by BlackRock and replicates the performance of the S&P Total Market Index. By investing into the XUU, you are indirectly buying a slice of 2,528 companies in the US, which include large, mid, and small cap companies. You'll not be diversified by country, unlike with the XEQT we just talked about, as the XUU only invests in US companies, but you get broad diversification into different sectors, which you can see down here. This ETF covers everything from IT, financials, healthcare, industrials, communications, energy, real estate, and utilities. In the past 5 years, the XUU grew by 16.45% on average, which is really high. It also grew on average 14.17% since inception, which was in 2015. This means that if you had invested $1,000 in the XXU since 2015, you would have about $3,763 now. XUU is great for you if you believe that the US as a whole, across all sectors and even smaller and mid-sized companies, will experience strong and consistent growth in the long term. So what do you think? The MER is also super low at 0.07%. That's $70 for every $100,000 of holdings you have. Let's also look at the yield. The trailing yield is 1%, while the distribution yield is 1.34%. Lower than what we had before, but remember, we are looking at growth ETFs. The dividends are just a plus. Dividend ETFs, on the other hand, pay higher dividends, but typically grow at a slower rate. Video for another time. Before we go on to number 2 and 1, what do you think of these ETFs so far? Are you already investing in some of these, or are you thinking of switching to some of these ETFs? I've made a lot of changes to my portfolio throughout the year to optimize it for more growth. And nowadays, it's easily done, as you can buy and sell stocks and ETFs without paying any commission fees on investment platforms like Wealthsimple and also Questrade. I have accounts with both of them, but I've used Wealthsimple the longest, probably because I have a slight preference for their user interface, which is just so easy to use, especially for beginners. So if you want to try it Wealthsimple, you can earn a $25 bonus just by opening an account and funding it with $1 by using my referral code in the descriptions down below. Now let's move on. Top ETF number 2 is the ZNQ, which you could call a tech ETF as it invests mostly in tech stocks. It's issued by BMO and tracks the performance of the Nasdaq 100. The Nasdaq 100 tracks 100 of the largest non-financial securities listed on the Nasdaq stock market. So this includes favorite tech stocks like Apple and Amazon, but also lesser known companies like Vertex Pharmaceuticals or Gilead Sciences, which are both biotech companies. In the past 5 years, the ZNQ grew by 22.2% and 22.31% since inception in 2019. The ZNQ is great for you if you believe tech stocks will continue to grow strong. I personally think it has great potential, but please note, all of these growth stocks I talk about here are medium to medium high risk. This means that while they are likely to have strong growth in the future, they are also more volatile. These ETFs we talked about so far are on one hand highly diversified in terms of the number of holdings they have, but on the other hand are also concentrated. Concentrated in terms of either geography, for example, just the US market or just the Canadian market, or sector, for example, concentrated in the tech sector. That's why it's really important to diversify beyond this so you don't just hold one ETF in your entire portfolio and nothing else. When thinking about diversifying, also think what kind of exposure you want to get. What asset classes? Just stocks, or perhaps also bonds, or even Bitcoin? And what industries do you want to be exposed to? Just tech, or also the health industry or financial sector? And what geographical exposure do you want to have? Just the USA or also Asia? Also, if you invest money in any of these ETFs, make sure that you don't need to withdraw the money in short time and are forced to sell the ETF at a bad time when the price is down. It's really important when considering what ETF to buy to think about how it fits into your overall portfolio and how much risk you are willing to take. Watch this video up here I made recently about portfolio allocation for beginners that teaches you all the things you need to consider when making decisions about what kind of investments to make. Back to ZNQ, let's also look at the MER, which is a bit higher at 0.39%, but still much lower than the actively managed funds where the MER can go up to 1%. Let's look at the impact that could have on your holdings. If you hold $100,000 in ZNQ, 0.39% would mean $390. This is of course significantly higher than what we had before, and yes, the fees do add up over time, but here's what you need to consider. This ETF, the ZNQ, has also had a much higher performance at a 5-year average growth of 22.2%, which in my opinion makes the 0.39% MER negligible. Now looking at the yield, ZNQ has a distribution yield of 0.3%, tiny. So again, the ZNQ is a growth ETF in its truest sense. Closely tied with the ZNQ is also the TEC. Issued by TD, it tracks the Solactive Global Technology Leaders Index. It had a 5-year average performance of 22%, very similar, and also an MER of 0.39%. Now moving on to ETF number 1, which is the VFV. The VFV is issued by Vanguard and tracks the S&P 500 index. So by buying the VFV, you'll automatically benefit from the growth of the 500 largest companies in the US, like Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and so on, and have exposure to various sectors. Same as the other ETFs, this VFV is a passively managed fund, which is extremely important. This means that this ETF simply tracks an index that already exists, with no extremely high-paid managers meddling in the fund and making decisions about what to invest in, and what for, as it's been shown that these tend to underperform. So sticking with passively managed ETFs is a better choice. At least that's what I do. The VFV's 5-year average performance was 16.95% and 17.88% since inception in 2012, which is pretty solid. This fund is for you if you believe that the largest US companies will continue to grow rapidly. Also note that the S&P 500 and other indexes or indices are not static. This means that companies that decline and no longer meet the market cap requirement can be removed and replaced with other growing companies. The MER is also very low at 0.09%. Plus a small yield, a tracking yield of 0.95%, or a distribution yield of 1%. Now to close off, here's my investing tip on saving hundreds, even thousands of dollars in taxes. When your investments grow and you sell them, you'll have a capital gain that's taxable. Your dividends earned are also taxable if you hold them in a non-registered account. That's why it's super important to make use of your registered accounts, the TFSA and or the RSP. When you invest money into these accounts, you don't need to pay taxes on any investment gains or interest and dividends you receive in these accounts. Watch this video next to learn more about the TFSA and RSP. See you in the next one.